Welcome to Philips Securities CFD webinar series, and thank you for joining us on the topic Complement Your Trading Strategies with Philips CFD. My name is Cheryl Chen, a dealer with the Philips CFD desk, and I'm here to introduce to you what is CFD, why it is such a popular trading instrument today, and how you can leverage on it for your trading portfolio. Philips Securities is proud to be the first broking house to bring CFDs to Singapore and continue to focus our efforts on investment education and product innovation to give our clients the highest service levels. Before we begin, we would like to highlight the importance of our risk disclosures and terms of trading. These presentation slides are presented to you for information only and do not constitute an offer or solicitation to purchase or sell the product mentioned. Hypothetical examples used in these presentation slides are for illustration purposes only. You may wish to seek advice from a financial advisor before undertaking transactions in CFDs. You may sustain a total loss of the initial margin funds and any additional funds placed with the firm to maintain your position. If your investment objective is capital preservation or your risk tolerance is low, we recommend that you study CFDs more carefully as to whether it is a suitable trading instrument for your use. What are contracts for difference and why should you trade them? CFD stands for Contracts for Difference. It is a simple yet powerful trading instrument that allows you to leverage on opportunities in the uptrend and downtrend markets. Simply put, CFD is a trading instrument that allows you to participate in the price movement of an underlying share or index without the need for rights to ownership. In normal cash trading, shares are delivered to the client's central depository account days after the trading day. One interesting benefit of using CFDs is that profits and losses are returned to the client's account instantaneously. For CFD trading, only cash settlement takes place because it allows the investor to avoid physical shares delivery. This is beneficial for clients who are not interested in ownership rights of the shares. A CFD is essentially a contractual agreement between two parties to settle the difference between the closing and opening price at the close of contract. For example, you bought one lot of ABC stock at $1 using CFDs and sold off the contract at $1.40. The CFD contract will state the opening price, closing price, quantity transacted, and profits or losses due to this transaction. The agreement is between yourself as a client and Philips Securities, which means when you buy, Philips Securities is selling to you. When you sell, Philips Securities is buying from you. That means Philips Securities is the liquidity provider and your counterparty. Trading CFDs allow investors to complement their current trading strategies, as it allows them to short sell conveniently, trade with flexible trading strategies, and diversify up to 10 times leverage on equities CFD. The formula for calculating the gross profit or loss for equity CFDs equals closing price minus opening price multiplied by quantity. This is exactly how you calculate the gross profit and loss for stocks trades. So if you're familiar with stocks trading, you will find CFD trading very similar and easy to learn. CFDs are derivatives, which means it derives its price from underlying instruments such as stocks, indices, and so on. However, it is one of the derivatives that mirrors the actual underlying instrument most closely. So if the price of stock ABC is $1, $1.01, then the CFD price will be $1, $1.01 without additional spreads quoted on top of what you see in the cash market. Everything you knew about the stock, including implied volatility, would directly apply to the CFD because of this price transparency. As an over-the-counter trading instrument, CFDs are not exchange traded. Philips Securities offers two major categories of CFDs, namely equities CFDs, which includes share CFD and share CFD direct market access, and world indices CFDs, which we'll go into more detail later in this presentation. The greatest advantage of using CFDs is that it allows investors to potentially profit from the market, whether it is going up or down. This presents investors an opportunity to profit whether it is a bull or bear market, even though certain stock exchanges may pose regulations that restrict short selling. For example, the Singapore Stock Exchange prohibits naked shorting if the position is not covered within the same day, and also imposes a huge penalty on such actions. Being able to short sell and buy long from the same account allows investors to switch strategies flexibly as the market conditions change. Some of these strategies include hedging and pairs trading. If you're familiar with technical analysis, you can see that you profit when you buy or take a long position when the price goes up, and make a loss when the price comes down. Similarly, you profit when you short sell or take a short position when the price comes down, and make a loss when the price goes up. Do remember that it is possible to lose more than what you put in, which is why it is important to practice strict risk management and cut loss where required using the right trading platform. The second advantage of using CFDs is that investors do not need to borrow shares to short sell, which is an administrative hassle. In traditional stocks trading, a client could open a shares borrowing and lending account, also known as SBL, to borrow shares, but this account type only allows the client to short sell, so investors may lose out on uptrending opportunities. Typically, the client needs to check with SBL if the quantity of a specified stock is available for borrowing, and upon confirmation, SBL will deliver the shares to the client's central depository account to allow the client to short sell the stock. Once he buys it back, he has to return the shares to SBL. On the other hand, he would also need to open a margin account to buy shares on margin, which gives him a maximum of 3.3 times leverage. The disadvantage of a margin account is that it does not allow short selling, which means investors may lose out on downtrending opportunities. Thus, when the market goes against their favor, there's little the investor can do besides cutting loss or waiting for the price to return to the desired level. A CFD account allows you to long and short using one account, which centralizes the profits and losses and allows you to change strategies flexibly. Investors can use CFD as a diversification tool because it allows them to trade for margin requirements as low as 10% for certain shares CFDs and 5% for world indices CFDs. This allows them to make their capital work harder for them and possibly achieve higher return on equity. This effectively frees up capital for other investments such as real estate, futures, FX trading, ETF, unit trusts, insurance, and so on. You could have only bought one lot of a blue chip stock in the normal cash market, but using the same capital, you could strengthen your portfolio by buying up to 10 lots of the same stock with CFD. As you can potentially lose more than what you put in, we recommend that investors trade CFDs with caution and use a trading platform that allows advanced order types such as stop limit orders to manage the risk in CFD trading. CFDs allow clients to diversify away part of the risk as clients can trade across 5 major exchanges, mainly SGX, KLSE, HKSE, NYSE, and Nasdaq. Investors who trade in only one market faces potential domestic risks, which could send its stock prices against the trend of the other major exchanges. So trading across different markets helps to diversify your trading portfolio. For the corporate actions that Philips CFD caters for, the dividends and adjustments would be credited or debited to and from the account on the ex-date instead of payable date. If a client goes short on a stock that pays dividends, the gross amount of dividends will be debited from his account. If a client goes long on a stock that pays dividends, he will receive net dividends in his account. Philips CFD caters to actions such as dividends, bonus shares, and reverse splits, but does not cater for rights issues, shares entitlements, and warrants issues. For the latter, Philips CFD has the right to advise clients to liquidate outstanding contracts before ex-date. In particular, short positions are subjected to forced closure if shares used for CFD hedge is being recalled by the lender. The golden rule in shares CFD trading is always to sell at the bid price and buy at the ask price. Another type of CFD under the category of equity CFD is shares direct market access CFD, or shares CFD DMA for short. Philips Securities offers both types of equity CFD trading that cater to the different trading preferences of our clients. When a client submits a shares CFD DMA order, Philip Securities sends a corresponding order to the exchange for the counter upon receipt of the client's order. Clients enjoy up to 10 times leverage using Philip CFD DMA. As CFD DMA is traded on margin, clients only need to pay as low as 10% of the total contract value to establish a position. DMA also allows clients to participate in the order book of the exchange, and this gives the investors greater visibility and control of their order. When clients place a CFD DMA trade, they can see that trade appearing in the actual exchange. This exposes them to the order book of the exchange and allows clients to participate in the exact market depth. Now clients have the ability to place overnight orders for the next trading day. Besides the actual exchange trading hours, investors can also participate in the pre-opening and pre-closing sessions of the exchange. The main difference between CFD DMA and shares CFD is that CFD DMA orders are done based on last done prices, which is a system very similar to cash trading. As for shares CFD, orders submitted may or may not be reflected in the exchange, and the orders are done based on bid and ask prices. As CFD DMA trading is a premium service relative to shares CFD trading, commission rates on shares CFD are relatively lower, which is an important advantage for investors who focus on keeping their trading costs low. Besides equities CFD, Philip Securities offers World Indices CFD, which is a suite of global indices that tracks the level of the index, although the prices may differ from actual index levels. This allows investors to trade the underlying indices directly, whether it is an uptrending or downtrending market. With only 5% to 10% margin requirement, investors can effectively trade 10 to 20 times their investment capital. World Indices CFD includes Straits Times Index CFD, Hong Kong 40 Index CFD, Japan 225 Index CFD, Wall Street Index CFD, US SP 500 Index CFD, and US Tech 100 Index CFD. One of the most popular indices traded on World Indices CFD is Straits Times Index CFD. Currently, Philip Securities is the only CFD provider in Singapore that offers clients trading access to the Straits Times Index. The next few slides shows an example of how CFD trading can complement investors' trading strategies. Let's assume that client A bought one lot of ABC component shares at $15.43 in the cash market on the 15th of April 2010, which was a peak price. The price came tumbling down soon after. What options does client A have at this point? For the purpose of this example, we will assume bearish conditions. If this client did not know about CFD, he could hold on to the position and wait for an opportune time to cut his positions. In this case, he waited till the 10th of June, but the price kept falling to $13.24. His losses from this cash trade was $2,190. Commission incurred was $85.89, and exchange fees came up to $14.57. In total, the net loss incurred was $2,284.84. If client A chooses to use CFD as a hedging instrument to lessen his losses, he could hedge fully by establishing an opposite position in a highly correlated counter of a similar stock value. As CFD allows up to 10 times leverage, client A will be able to reduce the upfront capital required in the trade. Some clients feel that once they leave the market, it is very hard to re-enter. These clients can still choose to hedge but with the same counter. Client A can short sell ABC using equity CFD at $15.43 and buy back at $13.24. With CFD, they only need to come up with a portion of the contract value as margin requirement. This trade would have given client A a gross profit of $2,190. After taking into account commission of $45.42 and finance charges of $85.90, the net loss from this hedging position is only $226.16. This hedging trade has helped him to recoup some of the loss incurred previously. Do note that in the above two examples, we have assumed bearish conditions, and in some cases he could have lost more than what he invested in his trades. Before you begin trading, we recommend that you read through our product information sheet, terms and conditions, and risk disclosure statements.